Shall we go into problem? Only problem solve. We have only 7 questions. Fatafat Limited took over a running business with effect from 1st April 2011. The company was incorporated on 1st August 2011. The following profit and loss account has been prepared for the year ended 31st March 2012. Gross profit, salary, stationery, travelling expense, advertisement, miscellaneous trade expense, rent, electricity charges, director's fee, bad debts, commission to selling agent, audit fee, debenture interest, interest paid to vendors, selling expenses, depreciation on fixed assets, net profit. Additional information. Total sales for the year amounts to rupees 19,20,000. Arose evenly up to the date of 30/9/2011. Thereafter, they spurted to record an increase of 2/3 during the rest of the year. Rent of office building was paid at rupees 2,000 per month up to September 2011. Thereafter, it was increased by rupees 400 per month. Travelling expense include 4,800 towards sales promotion. Depreciation includes rupees 600 for assets acquired in the post-incorporation period. Purchase consideration was discharged by the company on 30th September 2011 by issuing equity shares of rupees 10 each. Prepare the profit and loss account in columnar form, showing distinctly the allocation of expenses between pre and post incorporation periods. Say, after preparing the format of our presentation, we will be having various working notes. So let us have run through the solution, the question to know how many working notes, what working notes required. Shall we? Gross profit will be directly allocated in the proportion of, that is allocated in the proportion of sales ratio. So no working note required. Salaries, time ratio. Stationery, travelling expenses 16,800. In the absence of information, I will take in the time ratio. Suppose they give travelers commission means in the sales ratio, travelling expense means time ratio, because we don't know whether it is for sales or for any other purpose and all. So thereby normally if we can't relate anything to sales, we usually apportion in the time base only. Understood? So thereby travelling expense usually time ratio, but there is some information given. The travelling expense include rupees towards sales promotion. So maybe you can provide a working note and split the travelling expense into travelling expense based on time and then balance sales promotion, the proportion of sales. Clear? Advertisement, sales ratio, miscellaneous trade expense, time ratio. Trade expense does not mean selling expense. Understood? It is an expense relating to our business, that's all. Thereby it is time ratio. Rent, specific allocation. So we understand some adjustments given. So working note number 4. Working note number 1, 2, 3. Travelling expense. 4. Rent. Electricity charges. Director's fee. Directly to post. Bad debts. Sales ratio. Bad debts will be apportioned in the proportion of commission to selling agents, audit fee, debenture interest, interest paid to vendors. I draw your attention, interest paid to vendor. Here in such problem, the term vendor means the seller of the business. Fatafat Limited took over a running business, no. So the company have purchased running business from one person. Respond. So the consideration, a big amount of consideration payable to the seller of the business. So that seller of the business is called the vendor. Correct? We are having an obligation to pay consideration. On which date? On the incorporation date or on the takeover date? On the takeover date. Correct? If you are settling that, well and good. Generally that won't be settled. Normally it happens to be settled only after company's formation. Who should settle? Directors or promoters or company? Company, correct? So even though the contract or initially terms and all agreed by the promoters, it is actually a contract between company and the seller of the business, correct? The seller of the business is what we call it as. So it is not vendor of goods, it is not vendor of asset, vendor of business. In this problem, one company taking over another business, no? Please respond, pa. So in that case, the huge consideration payable on the date of takeover, correct? But normally the consideration will be paid after the takeover, after the incorporation. So thereby interest has to be paid for such amount due, correct? Please respond. Now this interest will be apportioned to pre and based on the period to which interest is related to. This will be apportioned based on, this will be apportioned to pre and based on the period to which interest is related to, correct? So interest will be related to which period? Interest will be related from the date of till the amount is settled. Please respond, pa. So you can't tell always this is interest paid to vendor means always pre and all. Understood? It is based upon to which period the interest is relating to or interest is paid. Could you appreciate that? So in this problem, the consideration was paid on what date? Look into the question, my dear. Consideration to the vendor was paid on what date? When is that we took over that business? 1st April. So thereby we understand this interest is relating to 1st April to 30th September. Just because of it is paid to vendor, we can't tell this interest is always pre and all. We should be seeing to which period this interest is relating to. Could you appreciate that? So this interest is relating to the period 1st April. No sleeping, not possible. So 1st April to 30th September. 1st April to 30th September. Understood? So this interest is relating to the period 1st April to 30th September. Only you should open the mouth, otherwise you are sleeping, you are about to sleep. So sleep will go if you are spelling out, if you are responding. Listen here. So it is this way. The interest will be relating to the period 1st April to, that is from dash date to dash date. From the date of takeover, not from incorporation, from the date of to the incorporation data. No, to the, because after incorporation the consideration may be settled, but not necessary that settlement should happen on the incorporation date. It may be later than that also, correct? Here when it was incorporated, on the date settlement made, no, if that settlement made on that date, now the entire interest is free. If the consideration was paid on the date of incorporation, entire interest would have been, but here the consideration was paid on what date? So thereby interest is relating to 1st April to, which means how many months interest it is relating to? Question ka answer. How many months interest relating to? In that 6 months, we understand 4 months is pre, 2 months is post. So thereby it should be apportioned in the proportion of 4:2. Is that clear? Yes, so this interest is for 12 months or 6 months? 6 months. That 6 months interest. 4 months is and 2 months is. For that you should provide a working note. Clear? Pakka? Okay, next one. Selling expenses. Which ratio? Sales ratio. What is next? Depreciation on fixed asset. Which ratio? Depreciation on fixed assets. It is time ratio, but here there is some information given, thereby specific allocation. Understood? Yes, sir. So please stop talking. So we have what and all means? Time ratio, sales ratio, direct allocation, traveling expenses, rent. Then we have interest to vendors and depreciation on fixed assets. 6 workings you will present. Clear? And our normal format of P&L, and like that we are arriving, we are going to apportion the profit into pre and post. Shall we? Statement of profit and loss showing the apportionment profit or loss into pre and post incorporation period. We have particulars. So please stop talking. Particulars, basis, by gross profit, sales ratio, we don't know. So for that we should go for the working notes. Everybody? We have working note, time ratio, friends, please stop talking. Time ratio, pre-incorporation period, 1st April 2011 to 1st August 2011. It is 4 months. Post incorporation period, 1st August 2011 to 31st March 2012. It is 8 months. So time ratio is 4:8 or 1:2. Second one, sales ratio. Sales ratio we find for pre-incorporation period and post incorporation period. Number of months, sales weight combined. Pre-incorporation period, post-incorporation period. Number of months, sales weight combined. Number of months during pre-incorporation period is, and post-incorporation period 8 months. Everybody? Yes, it was given that the sales were even throughout this up to 30th September. Thereafter it was spurted to, oh, it was up to 30th September. Yes, like this you should not do. How we should do means, sales ratio we find that sales was even up to 30th, after which it was increased by. So in the pre-incorporation period, we find that we have only 4 months, correct? Yes, everybody? Yes, so in the pre-incorporation period, we find number of months is 4. So in the post-incorporation period, we are having 8 months. Shall we? Yes, now, before the increase in sales, let the sales be 3. After that, it will become 5. Why it is 3 means? Now listen, please settle down, my dear. In the after increase, the sales was increased by 2/3. The sales was increased by 2/3. So I want some number which is divisible by 3. Otherwise I will get decimal. Everybody? Just to avoid this negative decimal calculation, what I would like to take is that you can assume any number for anything. Respond. I am taking April to September sales 3. Each month the sale is 3. So which means after that September sales will become why 5? Because it is increased by 2/3. 3 plus 3 into 2 by 3. Are you following? So what is 2/3 of 3? 2. So 3 plus 2, 5. Could you appreciate that? If you assume a number 2, initially if you assume a number 2, then it is 2 plus 2 into 2 by 3, and then LCM or decimals, all these things it will come, correct? So thereby I am taking a number which is conveniently divisible by 3. Suppose you take it through 2 or number 1, still you will be getting same answer only. Answer will be same. Only thing is I want to avoid decimal in my computation. Thereby I am taking a number which is divisible by. Suppose they are telling the sale, everybody, this sale was increased by 2/5. Then I would have taken the number 5. The sale was increased by 3/7. I would have taken the number 7. That's all. Simple logic. Understood? It is not that some other reasons are there behind me taking number 3. So it is just that the sale was increased by 2/3, and thereby I am taking a number 3 just for avoiding the decimal calculation. Understood? Is that clear? Everybody? So thereby before increase the sale is assumed as. So we are just assuming monthly sales before increase be 3, correct? Respond. After increase it is 3 into 2/3 equal to 5. Is that clear? So in the pre-incorporation period, it is 4 into 3, it is 12. In the post-incorporation period, it is 2 into 3 and 6 into 5, it is 36. Therefore, sales ratio equal to 12:36. That is 1:3. You understand this?
Yes, sir.
Pakka?
Yes, sir.
Sales up to 30th September were even. After which they were spurted to increase by 2/3 during the rest of the year. Understood? So thereby I want a number which is divisible by 3, so that I am getting a whole number. Understood? So thereby I took the number before increase as 3, so that after increase it is 3 plus 3 into 2/3, it is 5. Understood? And though up to September it was 3, but in the pre-incorporation period it is not up to September, it is only up to July. April, May, June and July. So how many months? 4 months. So thereby it took 4 into 3, 12. Understood? Post incorporation period, August and September 3, and from October onwards it is 5, and thereby 6 months into 5. That way we arrived at sales ratios 1:3. Understood? So in this topic now, sir, identifying time ratio and is the core part. If that is over, many of your income and expense will be apportioned in the proportion of this time ratio and sales ratio. Shall we proceed? Next working note is for traveling expenses. Given how much? 16,800. In that, sales promotion 4,000, balance 12,000 based on time ratio, and this is based on sales ratio. Is that clear? Everybody, this will show in the direct statement. 12,000 we will write in the total, which will be apportioned in the time ratio, and 4,800 in the sales ratio. Is that clear? Now listen. Next working, please don't copy, sir, listen carefully. What is next we have? Rent. What is the rent given? 26. We need to split this into pre and post. It was given like this, that rent of the office building was paid rupees up to September. Everybody, after that it was increased by, so which is very simple. In the pre-incorporation period, we had 4 months where we paid how much? 2,000 rupees. 8,000. Clear? In the post-incorporation period, for another 2 months, it was still 2,000 only. 4,000. For 6 months, it is 2,400. 14,400, which is 18,400. Understood? We can arrive balancing figure, but still I would like to show that how the information given, that from October onwards it was increased to 2,400. So pre-incorporation is 8,000 and post-incorporation not based on time ratio, not based on specific information available. We classified, we apportioned that into pre and post. Everybody, are you all following? Next one. Interest paid to vendor. Rupees how much? 4,800. 4,200. Everybody. So we are splitting this interest into pre and post for 4 months and 2 months. So thereby 4,200 into 4 by 6 and 4,200 into 2 by 6, 1,400. Everybody, now we'll provide a note. Interest is for the period from the date of takeover to the date of settlement, that is 1/4/2011 to 39/2011 for 6 months. So this interest is for a span of in that 4 months is falling in pre and 2 months is falling in post. Could you appreciate that? So we're just making the point very clear. This interest is not for 12 months to be apportioned in the time ratio. This interest is some special interest given to the vendor. Who is the vendor? Seller of the business, to whom we should have given consideration on the date of buying the business. The buying the business took place on what date? 1st April. The buying the business took place on, we were incorporated on 1st of, but we gave the consideration only on 30th September. So thereby it is from the date of buying the business till we repay the consideration, that is 30th September. So thereby interest is for how many months? 6 months. From that 6 months, 4 months is falling in pre and 2 months is falling in post. Is that clear? Everybody? Like that only we split this into pre and post incorporation period. So it is depreciation. How much given? Usually in what ratio, ba? Time ratio. But in this problem they are telling that depreciation of rupees for assets acquired in the, which means exclusively post. Understand that? How much? 600. Everybody. So 9,600. 600 is relating to the asset purchased only in the post incorporation period. So this is only post. So 9,000 is fully pre. You should not tell. Exactly. This balance rupees 9,000 for the assets existing throughout the year. So should be split into pre and post. Time ratio of 1:2. So 3,000 and 6,000, which means totally 6,600. So this is pre and 6,600 is post. Clear? Like that, working notes completed. Proceeding to the original solution. Please listen, pa. So it is gross profit, sales ratio, 1:3, total 3,20,000, 80,000, 2,40,000. Now, other items, please help me out. 2 salaries. Time ratio 1:2. 48,000, 16,000, 32,000. Next. Time ratio 1:2. 4,800. 3,200. Next. Traveling expenses. Traveling expenses time ratio 1:2. 12,000. Correct? Respond. So we understand 16,800 was there. But in our working note number 3, 12,000 is based on 4,800 is based on sales. Correct, Appa? So traveling expenses based on time ratio 12,000, 4,000 and 8,000. Are you following? Then we have sales. Sales promotion expenses. Everybody? Sales promotion in the sales ratio 1:3. 4,000. This breakup we have shown in working note number 3. And the actual travel expense, one more. So actual travel expenses is 12,000 rupees, which will be apportioned in the proportion of time ratio, and sales promotion in the 1:3 ratio, sales ratio. Understood? Next one. Advertisement expenses, sales ratio 1:3. 16,000, 12,000. To miscellaneous trade expenses, time ratio 1:2. 37,800, 12,600, 20. Okay, next. To rent. Rent specific, correct? Specific. Working note number 4. Total 8,000, 18,400. Next. Electricity. 1:2. Next, director's fee, direct allocation to the post, 11,200, nil, 11,200. Bad debts, sales ratio 1:3, 3,200, 2,400. Commission to sales ratio 1:3, 16,000 and 12,000. Everybody. Next, to audit fees, time ratio 1:2, 6,000, 2,000, 4,000. Everybody. Then, debenture interest, direct, post, 3,000, nil, 3,000. To interest paid to vendors, specific, working note number 5, 4,000, 2,800, 1,400. Next, selling expenses, sales ratio 3, 25,200, 6,900. Do depreciation, specific, working note number 6, 9,600. Everybody? Now tell me, what is the pre-incorporation profit or loss? Take this 80,000, deduct all these items. Pre, 12,300. Profit will be considered as capital reserve. 12,300, 12,300. To net profit 75, that's all. 8 marks. See, those expenses which cannot be identified with sales will always be apportioned in the time ratio. Even though sometimes we may feel that it may not vary with time, but no other choice left, we will take only time ratio. Electricity charges. Sir, more the sales, more the electricity, more the time performed, more production may be there. So like that, so many arguments can be placed. But if you cannot directly place an expense which directly vary with sales, if you cannot directly establish relationship with sales, then automatically it will be apportioned in the time ratio, even though it may not be fully fitting into time ratio. Trade expense is not selling expense. Suppose in your P&L final accounts in higher secondary we teach like this. In trial balance we are showing something called trade expense. You know where you will show? In trading account or in P&L account? Trade expense in trial balance. Do you show the trade expense in trading account or in P&L account? It will be shown in P&L account. Then we will teach them one more thing, that If there is a separate heading called trade expense and office expense, if we have a separate heading called trade expense and office expense, then we tell them that office expense should be shown in the P&L and trade expense should be shown in the trading account. But otherwise the trade expense should come only in P&L. So it is not directly relating to sales. Could you appreciate that? And thereby the miscellaneous trade expense, you cannot, unless you can directly relate to that sales, it is not sales ratio, it is only time ratio. Could you appreciate that? So thereby miscellaneous trade expense was considered in the time ratio. Understood? Audit fees, I already told that it has to be only in time ratio, because the auditor is not performing audit throughout the year, but auditor will cover all the aspects of the financial information, financial statement, and thereby it should be in what ratio? Time ratio. Is that clear? Pre-incorporation period. The company was incorporated on 1st July to take over the business from 1/4/2012. So 1/4/2012 to 1/7/2012, that is 3 months. Post incorporation period 1/7/2012 to 31st March 2013, 9 months. So time ratio is 3:9 or 1:3. What is sales ratio? Pre-incorporation period and post-incorporation period. In the pre, it is the April, May and June. April, May, June of 2012. Everybody? In the post incorporation period. Answer? Super. Five. Okay. Okay. First convey the correct answer. Shall we proceed? So, post incorporation period, it is July, August, September, October, November and December. Everybody? It's given that sales from September onwards, average monthly turnover from September onwards was double than that of average monthly turnover for the first 4 months. Let the first 4 months sales be 100. First 4 months sales of current year be, from September onwards it has doubled, so it becomes 200. In August the sales was 150% of the sales of the following month. So which means the August month sales will be 150% of following month, which is September. So this sales will be 300. Suppose you take the number 1.53, everything is correct only. Understood? It is not that you should take only the number 100. You take any number, still you should be getting the same answer only. Understood? So now this is 300. Aggregate of Jan, Feb, March left. 200 1,800. Sales ratio is 300 is to 1,800 or 1 is to 6. Gross profit usually in sales ratio. Commission, advertisement, discount, director's fee, salaries, depreciation, insurance, preliminary expenses, directly to rent and taxes, specific working note, bad debts, specific, interest to vendor, specific, audit fee, bad debts recovered, direct to pre. Bad debts recovered is income. It is income. It will come in the credit side. And it will come specific to the period in which the money was recovered. So please listen. Bad debts recovery is not some activity performed throughout the year. Suddenly what you have written off as bad, you are getting an income, means that is an income only when it is received. So thereby naturally it should be the income for the date in which the money was received, and thereby since it is received on what date? 1/5/2012, it will directly be attributable to that date only, and which is falling in pre, and thereby bad debts recovered will be taken in pre-incorporation period. Understood? Then this is for the purpose of sales ratio, which we already discussed. Rent, bad debts and audit fee. Audit fee anyway we have already considered. So which and all require working notes other than the time ratio and sales ratio means? We have rent and taxes, bad debts, interest paid to vendor. Shall we? Now let us take all these items. Gross profit by gross profit basis 1 is to 98,000, 14,000. Okay. Bad debts recovered, direct, not specific, pre. Sir, please understand, bad debts recovered is not always pre. When I say direct, you should not misunderstand here. Oh, which means bad debts recovered na always pre. Like that don't bring. Suppose it was in the post-incorporation period, money received means it is belonging to post only. Understood? So since in this problem it was received in pre, it is taken as pre. So 500 nil. Debit items, what and all? Commission, sales ratio 1 is to 6, 2625, 375, 22. Next, to advertisement, sales ratio 5250, 750. Okay. One is to okay. Two director's fees. Direct to the post. Then salaries, time ratio 1 is to 3, 18,000. Okay. Depreciation time ratio 2000, then to insurance time ratio then to preliminary expenses direct post rent and specific working note number, we'll take that later. Next, bad debts working note number, amount 1250. Next, interest to vendor working note number 2000. Then we have audit fees. Next, that's all. So we need to have these three working notes, shall we? Rent for the first 3 months was paid at rupees 20 per month. Thereafter it was increased by rupees 50 per month. Everybody? Now listen carefully. Working note number 3. Rent and taxes. Right? In this, how much given? 3000. Rent, taxes. Rent, pre, post. 20 per month into 3. Everybody? Thereafter it was, so 50 into, I'm sorry, good morning, 70 into 600 and, so 690, 2, 3, which will be apportioned in time ratio between pre and post, 1:3. Anything which you cannot identifiable to sales directly, when it is not clear, naturally use what ratio? Time ratio. This is the point time and again we are stressing. Sir, why taxes based on time? If tax can't be directly attributable to sales, then naturally we will be apportioning only in the time ratio. Understood? So that is the way we will be trying. So what is this? 57 13 32. Everybody? So total pre will be 578 plus 60, 638. Post 1732 plus 630, 2362. Are you following this? Bad debts, how much? 1250. Bad debts was given that from September 1 to March 31, it is only 350. September 1 to March 31, for 6 months it is 350. So 1st April to 31st August. 1st September 7 months. For 7 months it is 350 and this is 900. So we understand that 1/4 to 31st August it is 900 is the bad debts for a span of 5 months. Everybody? So thereby we would like to take this 900 which is for a span of 5 months. We like to split this into 3 months and 2 months. We like to split this 900 into 3 months and 2 months. Shall we? Bad debts will be apportioned in the proportion of. Bad debts will be apportioned in the proportion of sales ratio. Entire 1250 will not be in the proportion of sales ratio because we know that 350 is exclusively relating to 7 months. 350 is exclusively relating to. So this 5 months bad debts, no information given. So thereby we have to split this into 3 months and 2 months in the proportion of. Between that 5 months sales ratio we should find out. It is not the sales ratio of the year you can use. You should use the sales ratio during that 5 months. Are you following this? April to August some sales would have been conducted. In that sales, what is the sales proportion we should find out. Everybody. So we have computed the sales like this. For the first 3 months it is. And for the other 2 months it is 100 and total 400. Understood? So thereby the ratio between 3 months and 2 months sales is actually 300 is to 400, 3 is to 4. Are you following? So that's a twist here. So please do understand that bad debts totally 1250. In that 350 is exclusively relating to 7 months. Remaining 900 rupees is relating to 5 months. But I would like to know what is for the first, because that is a pre-incorporation period, correct? So that we will apportion the proportion of during that 3 months and 2 months. Not the annual sales ratio. So those expenses incurred for the annual period during the annual sales ratio, but this one is only for a span of how many months? So in that 5 months, whatever ratio applicable for sales, that ratio only I can use. I should not use 12 month sales ratio. Could you appreciate that? Thereby I will be using 3:4 ratio. That is 300 and this 100 and 300 which is 400. So thereby it is 3:4 sales ratio. Could you appreciate that? Are you following? A very special problem, sir. It has appeared in RTP. Every chance it can come in the examination also. So please thereby I try to understand that. Understood? Shall we? Everybody. Now proceeding. It is 900. 900 will be apportioned. 900 will be apportioned in the proportion of sales ratio. Bad debts for 5 months. It is 900, which we are splitting for 2 months and 3 months and 2 months. Everybody, in sales ratio. In sales ratio, which is 300 is to 400, that is 3:4. How much? 380? 51. So pre will be 386, post will be 514 plus 350, 864. Understood? So pre will be 386 and post will be 864. Is that clear? Respond. Then it was interest to vendor. Interest to vendor. How much given? 2000 rupees. Everybody. For the period from 1/4/2012. That was the date of takeover. Till the consideration was paid, they themselves are given. It is up to 1/10/2012 for 6 months. Correct? That is for 6 months. So how to split into pre and post? Please respond. First we are telling this interest is for how many months? This interest is for how many months? 6 months. Adala how many months is pre? 3 months is pre. So thereby it will be 1000 and 1000. 3 months pre and 3 months is post. Clear? It is not 9 months post because interest itself is related only for 6 months. So 3 months is pre, 3 months is post. So thereby it is 1000 and 1000. Understood? Everybody? So these are the items that we have to post. Rent and taxes. Can you tell how much? 630. Okay. 23. Okay. Bad debts. 386. 864. Sorry. 1000. 1000. Capital reserve. 54. 45. Everybody? So capital reserve is 5451 and net profit is 45,474. A company was incorporated on 1st May 2012 to take the business with effect from 1st of January 2012. In other words, it's a partnership firm which was converted into company. The first accounts are drawn up to 30th September 2012. The gross profit for the period is 56,000. The general expenses are 14,220, which will be apportioned based on time ratio. You should know that this expenses is for a span of 9 months. Everybody. You should know that the financial statement is covering a period from Jan 1 to 30th September. So the total period is only for 9 months. And in that 4 months is pre and 5 months is post. So it is 4:2 is the time ratio. We have already seen in one example it is 15 months. And in this problem we are seeing the period as 9 months. 4 months is pre and 5 months is post. These are all the questions which are appear in revision test papers. And every chance it can come in the examination. So please learn that problem properly. 14,220 is expense for how many months? 9 months. Director's fee 12,000 rupees per. You should know that director's fee first of all will come only in the post. So I should not find for 9 months. I should find only for 5 months and that I have to take exclusively in post. Everybody? Fine. So we will show separate working note for that. Formation expenses, preliminary expense 1,500. Directly to post. Formation expense of the company is called preliminary expenses, which will be apportioned or which will be allocated directly to post. Rent up to 30th June was 1,200 per annum, after which it was increased to 3,000 per annum. So take the rent appropriately for 9 months, 4 months and 5 months, separate working note, specific. Number 2, then salary of the manager who upon incorporation of the company was made a director was rupees 6,000 per annum. His remuneration thereafter was included in the above figure of fees to directors. There was a manager in the partnership firm. After this partnership firm was converted into a company, this manager is becoming one of the director. Respond. And his remuneration henceforth is to be included under director fees. So whatever director fee we consider here includes that manager's salary. So we need not do that any separate working. So what we should do is the salary to manager is applicable only for that 4 months salary to be computed, to be taken in exclusive pre-incorporation period. Understood? Respond. Give profit loss account. They have given information for you to find out sales ratio. That's all. Simple things only. Shall we? So which and all we are going to compute separately. Director's fees, rent, salary to manager. Understood? Let us compute one by one. Time ratio. Pre-incorporation period. Pre-incorporation period, it is 1/1/2000 to 1/5/2012. Please stop talking. Then post incorporation period, which is 1/5/2012 to 30/9/2012, 5 months. So therefore time ratio is 4:5. Then for sales ratio, how they have conveyed, please, at least from this question, how to analyze the information. The monthly average of which for the first 4 months of 2012 being 1/2 of that of the remaining period. So which means if after that 4 months, if 5th month onwards sale is 1, then in first 4 months each month the sale is half. If 5th month onwards it is 2, then the first 4 months will be 1. Everybody, let the sales in each month from May be 2. Everybody? So therefore sales in each month of first 4 months will be 1. Correct? Sales ratio equal to 4 into 1, 4. 5 into 2, 10. So thereby sales ratio is 4:10, 2:5. So time ratio is 4:5 and the sales ratio is 2:5. Understood? Now proceeding. Directors' fees. Exclusively for post incorporation period, that is 5 months, equal to 12,000 is for 1 year by 12 into 5, which is how much? 5,000. Fourth, rent. Now listen, rent will come in the pre as well as post. Pre for a span of 4 months. We understand. Rent up to 30th June was 1,200 per annum, which means, sir, please listen. Up to 30th June 2012, the rent was 1,200 per annum. Respond. So thereby it is actually 12 months for 1,200, for 1 month it is. So old rent is 100 rupees. Sorry. Thereafter it was increased to 3,000 per annum, which means for 1 month 250. Correct? Which means up to June rent is 100 rupees. July onwards rent is 250 rupees. Now for us, I want 1st January to 1st May. Correct? Respond. So thereby it is 1,200 by 12 into 4. How much? 400. For post incorporation period, 5 months. Correct? Which are the 5 months covered? May, June, July, August, September. In that, May and June is having old rent only. Everybody. So this is May and June. It is 2 months into 100, 200. July, August, September, 3 months into 250. So totally 950. So apportionment of rent is 400 for pre and 950 for post. Are you following? Then what else we have? Salary to manager exclusive for pre-incorporation period. It was 6,000 per annum, but for pre-incorporation period of 4 months, it is 2,000 rupees. Everybody. Now, gross profit given, how much? Gross profit basis, sales ratio, 2:5, 56,000, 16,000. Then various cost. General expenses, time ratio, 14,000. Okay. Next. Direct. Next. Formation expenses. Direct. Specific. One three. Manager salary. Direct. Pre. Working note number 5. What was 3 then? Working note number 3 was director's fees. Okay. 2000. 2000. That's all. So capital reserve. 7 to net profit. 2450. See, Agra Company incorporated on 1st April 2012. Took over the running business from 1st January 2012. The company prepares its first annual accounts on 31st December 2012. So one thing is sure, time ratio, even though they didn't ask you. They asked you that? No, only sales ratio. So time ratio is 3 months and 9 months, 1:3. Then they are asking you to compute sales ratio. Sales for Jan to December is 7,20,000. Okay. Point number 2. Sales for the month of January is twice of the average sales. For the month of February, it is equal to average sales. Sales of 4 months from May to August is 1/4 of average of each month. And sales for October and November is 3 times the average sales. Is the information given, right? Okay. In all the questions so far that we have solved, right from the previous class, 3 examples till now, the sales increase or decrease was given between one month to the other month. Say something like the relationship between pre-incorporation period sales to post-incorporation period sales was given. Correct? Everybody?
Yes, sir.
In this question, that sales increase or decrease or the sales relationship was established based on something called average sales. Was based on? Every month sales is not based on another month sales. It is not like March is based on February or some April and all. It says that it is based on average sales. Are you following this? So thereby you should be knowing that. Now first of all, it should be based on average sales. Sales for 12 months. 7,20,000. Monthly average. 7,20,000 by 12. It is 60,000. Now please listen carefully. We have 2012. Everybody? Jan. They are telling it is twice of average sales, not twice of sales of February or March. We are not telling 60,000 is sales of any month. 60,000 is average of that year. Are you following up? If they have expressed that January sales is 200 times of February sales and all, then we will express February sales be ₹1, like that we will express. Correct? Here everything is expressed based on what sales? Average sales. Understood? So January sales is given as twice of average sales. So thereby 1,20,000. Everybody? 60,000 into. Then February, then March, April not there, correct? Sorry, what is next given? Everybody? So we find that March, question mark, April, question mark, no information given. Next, May, June, July, August. What they are telling? Sales for 4 months from May to August is 1/4 of average of each month. So which means it is 15,000. 15,000. May to August is 1/4 of average sales, not 1/4 of January sales or February sales. Average sales. Are you following? So which is 15,000. Understood? Next, September, October, November, December. So we understand what is there given. May to August is 1/4 given. Then sales for October, November given as 3 times average. How much? 1,80,000. 1,80,000. 60,000 into 3. Everybody. September question mark, December question mark. No. October sales for October and November is 3 times the average sales. It is not October and November together. For sales of October, sales of November. That is how you should understand. No, but they see if it is for 3-4 months, they should tell for per month. Sales for October, sales for November is 3 times the average sales. So that is what you should be understanding. So thereby it is not 90, it is 1,80,000. Now can you take the total of this? It is 6 lakhs. Everybody, please respond. Which means we understand sales of March, April, September and December together is 1,20,000. Sales of March, April, September and December, that is 4 months, equal to 7,20,000 minus 6 lakhs. 1,20,000. Everybody? And we assume that this 1,20,000 was even in each of these 4 months. Are you following? So which means average sales in each month, in each of the above months will be 1,20,000 by 430,000. Like that we are analyzing the annual sales. Everybody? Now pre-incorporation period, which and all? Jan, Feb, March. 1 lakh. Sorry. 2,10,000. Post incorporation period, April, May, June, July, April, 30,000. May, 15,000. 15,000. August, September, October, November, December. 30,000. 5,10,000. Everybody? So we just find out that sales ratio is 21:51 or 7:70. Say once upon a time, there were 2 types of company, private limited company and public company. Listen. See, this private limited company can start business the moment it is getting certificate of incorporation. Pawan, this public company cannot do business after incorporation date. They have to get this public company, Pawan, that person to start business should get one extra certificate. We call this as certificate of commencement of business. Understood? So when this is there is confusion among people. For public company, the profit should be apportioned as pre-incorporation or pre-commencement. Are you following this? So there is two opinion exist. This is only it is only a conflicting area here. Different authors have different viewpoints. Institute doesn't even touch that area because it is conflicting in the discussion process. But when I just take up from various number of questions of institute sources, in one problem they have taken, even for public company also, certificate of incorporation. They are not considering the commencement of, and thereby for examination purpose, if you ask me personally, I would like to take only the certificate of commencement of business. A company is not allowed to make profit before it gets certificate of commencement. Are you following this? But this the topic is called profit prior to incorporation, and considering the strictest view of the title, and in one of the problem, instead of taken this particular stand that even for a public company, the apportion will be based on incorporation and not based on certificate of commencement. Even in case of public company, the profit will be apportioned based on the date of incorporation. The profit will be apportioned as pre and post. The profit will be apportioned, insert, as pre and post based on the date of incorporation and not based on the date of commencement, and not based on the date of commencement of business. Everybody? See, there are authors opining that it has to be based on commencement of business, and there are authors supporting only incorporation, and institute doesn't discuss in any place about this particular concept. In one of the problem they have taken, so same stand we are taking for all our problems in case we come across public company. Question number 2. A public company was formed to take over running business with effect from 1st April 2012. Company was incorporated on 1st of August. Certificate of commencement of business received only on 1st of October. The following P&L has been given: GP, salaries, printing, traveling expense, advertisement, blah blah, information given. Total sales for the year, which amount to 9,60,000, arose evenly up to the date of certificate of commencement, whereafter they spurted to record an increase of 2/3 during the rest of the year. Rent of office building was 1,000 per month, thereafter it was increased by 200 per month. Traveling expense includes rupees 2,400 towards sales promotion. So, any sort of memory comes to your mind? This is nothing but question number 7, Fatafat limited problem. Everybody? So, if you look into Fatafat, it is 48,000 salaries. Everybody, this is 24,000. So, numbers are exactly, everybody. So please, for practice, you can try this. It will not be worked out in the class. Understood? Exactly the same. So you can work out the answer accordingly. So this is gifted. Everybody?